And welcome back, everyone. I would like to welcome Andrew Thrasher, CMT. He's portfolio manager at the Financial Enhancement Group. Andrew specializes in technical analysis with a focus on market timing, sector rotation strategies, stock selection, and risk management. In 2017, he was a recipient of the Charles H. Dow Award given by the CMT Association for his research on equity market volatility. Andrew, it's a pleasure to have you today.
Thank you for having me on. It's nice to come talk about volatility on a Thursday afternoon.
Glad to have you.
So am I good just to get started? Can you still see my screen?
Screen looks great. You're all set.
All right, perfect. Well, I appreciate you guys coming to hear my talk. I'm going to be covering the paper that I wrote back in 2017 called Forecasting a Volatility Tsunami. And as during my intro said, that won the Charles Dow Award. My profession, we'll kind of get into a little bit of my background, but I'm a portfolio manager. I work for RA firm. Is just get a little bit of disclosure out of the way. Let's see, click here. Yeah, so we're a SEC registered investment advisor. So get through this, through all that stuff. So yeah, I'm a portfolio manager. We manage about 480 million, maybe a little bit more than that now. I also have a premium research letter that I write called Thrasher Analytics. I won the Dow Award, and my research has been featured in a lot of different publications, kind of all the major finance, Wall Street Journal, Business Week, Bloomberg. I'm on TD Ameritrade Network. Probably every couple of weeks, I'll be on actually next Thursday or Friday, talking about equities and volatility. I try to do that every couple of weeks on in the morning. So as a portfolio manager, that's my main focus, my main job. I kind of boil it down to two things. My job is to find opportunities to invest, and then also maintain very strict risk management principles. The clients that my firm works with, primarily retirement focused, they've worked their entire lives to build up these nest eggs, and whether they're trying to use it then for retirement income or maybe to pass down to future generations or charities or different goals and priorities for each. But it's our job to help grow that, but more importantly, we're really focused on the risk management side, really to preserve those assets for what our clients are trying to accomplish. And so with it, always trying to find different ways to manage risk, whether that be through equities, through fixed income, currencies, what have you. And the risk management, and I think this year has kind of been a great example of that, as the stock market's a roller coaster. Right now, we're kind of on that upward slope right now since March, but if you've been investing for more than a couple months, that drop off should be pretty familiar. We saw that in March, where stocks just went, they kind of took the escalator up and the elevator down, and that's pretty normal stock market behavior. Traditionally, we don't see it happen in 3 weeks like we did back in March, but the market does ebb and flow, goes up and down. And as a portfolio manager, I try to manage those drops of the roller coaster as best we can. And that was kind of what led to my research for my paper, was to avoid some of the largest market downturns. And what we often see in a lot of publications and a lot of other type of presentations is the buy and hold mentality, and they'll show oftentimes the first part of this table that if you miss the best days in the market, here's what your returns would be versus if you were to buy and hold and stay in the market the entire time. And so a lot of these charts, the first parts of them are coming from my paper that I wrote, and then I've updated, provide some more current examples of this later in the presentation. So if you've read my paper, I'll have the link at the end of this presentation to it. Some of this will look a little familiar. And so again, this was looking at a study done back in the 80s and 90s. This was through 84 to 98. That if you were to miss the 10 best days in the market, then your annualized return was 14%. If you missed the worst, then it was 24%. And the issue with that is oftentimes some of the best days are right around this time we have the worst days. And again, the great example of 2020 of that, where we've had these huge 5-6% moves in the S&P and the Dow, only to be followed by this almost the same velocity the next couple days later. So you can see here, these are the best days and the worst days on a rolling 30-day standard deviation. You can see a lot of the green and the red dots are kind of clustered together. To show that if you're going to miss some of the best, you're going to miss some of the worst. If you're going to miss some of the worst, you're probably going to have to sacrifice some of the best. And that's one of the arguments that gets made for buy and hold investing, that you can't try to dodge both, and just how awful that will be. However, if you were to dodge both, if you were to sacrifice some of the best days, the returns still, at least during this testing period, were still pretty admirable. If you miss the 10 best, if you miss both the 10 best and the 10 worst, your annualized return was still about 20%. Obviously, this was during the 90s when extremely strong up moves in the market. And so just the reason I like this time period was because even if you sacrifice some of those really good days in the 90s, then you still were able to have good appreciation annualized through that time period. We can see it here graphically another way. So this is again going back to 1950 through 2000, mid 2016, where if you just buy and held the market from 1950 all the way through, you had the red line. However, if you were to miss the best 25 days, but also the 25 worst days, then you have the black line. And so why I think this is so important and why I think active management is so critical is that volatility to the downside, those large declines are almost like a tax. It's like you have to give your money away, and because you have to dig such a hole down that you have to climb back out of, that a 50% return, a 50% drop requires 100% return to get back to even. And so being able to try to make those declines as small and as minimal as possible, it allows for you to be able to get back to that high water mark, to be able to recover much faster than if you just were to ride it all the way down and all the way up. And so one way to manage that, or one way to view those volatile periods, is the volatility index. What the volatility index does, when we're looking at the index version of it, is looking at the 30-day expected volatility for the S&P 500. So the VIX takes into account the options of the S&P 500 and comes up with a mathematically, this is how much volatility. It's non-directional, so this is how much volatility either up or down over the next 30 days. So typically the largest amount of volatility, those big volatility, come when the market goes down. Because remember, again, the market takes that escalator up, the elevator down. These down moves are much larger and much more volatile. So we often see the volatility index becomes negatively correlated to the S&P 500. It's not always negatively correlated, but it often typically is. And so by using the VIX as a gauge and as a tool to kind of forecast those, and like my paper was titled, Forecasting a Volatility Tsunami, forecasting those potentially large down moves, we're able to have that as a tool in our tool belt to better manage risk. And the financial press is obsessed with low volatility, and this is where a lot of people think when the VIX gets really low, that's what's going to precede these big spikes higher. They write about it constantly, bringing in all kinds of experts. The VIX is low, it can be dangerous for the market, but that's just not the case. The fact that the VIX is low has not been overly negative for future stock returns. And we can look at quantitatively, looking at the study done by BlackRock. What they did is they looked at the S&P returns following every time the VIX got below 14. So typically the median for the VIX is about around 20, 18 to 20, depending on your look back period there. So when it gets down to 14, what does the S&P do 3 months later? Well, if you see here, I'm not sure if you can see my mouse. If you can, then you can see I'm circling right. The average returns can be either plus 10 or minus 10. And the average, which is here, the orange bar there, is just above the zero line. So it's a pretty wide dispersion of possibilities when the VIX gets below 14. Either you're going to, 3 months later, you're going to either be down negative 12%, or you could be up 12%. I mean, that doesn't really give much predictive value there just because of the VIX is quote unquote low. And so looking at that, what I did in my paper is I said, okay, I want to look at how are we going to find a spike in volatility? There's no hard and fast definition for spikes in volatility. So what I just said, okay, in 3 days, the VIX goes up 30%. And if anyone trades volatility, then they just cringed because I put a percentage to a percentage. And I know that's a faux pas. Just stick with me. There had to be a way to kind of normalize all the results. So I fully admit you shouldn't do a percentage of a VIX because VIX is a percentage. But hopefully you'll give me a pass if you're a VIX trader and that just send a chill down your spine. But a 3-day change in VIX of at least 30% was a pretty good, in my view, estimator of a large move in volatility. So you can see it happened quite a bit. So this chart goes back to 2016. Each time we had a red dot, the VIX over 3 days went up at least 30%. So it gave us a pretty good sampling of large moves in volatility. So another belief is, well, if the VIX goes down a lot, then that's the VIX going down is a sign that sentiment is suggesting that we're going to see a big spike. People are getting too bullish. They've sent the VIX way too low. So I said, okay, well, what about when the VIX drops in 3 days, goes down 20%? And you see each time these red dots, and they don't really correspond to happening just before VIX spikes. They're kind of all over the place. It looks more random than anything else. And so again, looking at just when VIX is at the close, it's the lowest close in 4 weeks. So it's the lowest point for volatility in 4 weeks. Happens all the time. It happens all during when the market's coming off a high, it rides it all the way down. But if you look at, even if you were to screen out, the only time is below 20 and said, okay, if it's below 20, below the average, instead of 4-week low, it still was pretty random. And a way we can look at that is look at the changes in volatility when it's at the lowest. So this is a scatter plot that shows on the left-hand axis the 3-week change in VIX based off of what this max return when VIX is really low. And so whatever the VIX is, it looks at, okay, here's what the VIX return was 3 weeks later. And this version's pretty wide. So you could have some of the largest 3-week changes in volatility could have been when it was 10, or it could be when it was over 25. So it was regardless of where VIX was, whether it was low, high, medium, average, whatever, it didn't really give enough of a strong signal, enough of a predictor based off just the level in the VIX of what was coming next. And so my paper said, okay, what does? Is there any common environment, any type of commonality that precedes a lot of these big spikes higher? And there was. It was the dispersion of the VIX. And dispersion is just a fancy way of saying standard deviation. But what I found is when standard deviation, the dispersion gets really, really low, that the activity, which is done because the activity in the VIX has really calmed down, that we're not seeing these big spikes up and down. It's just kind of staying consistent. And so those standard deviation gets really low. That's the type of environment that precedes spikes in volatility. So you can see the largest changes over 3 weeks in the VIX all pretty much happened when the standard deviation was extremely, extremely low. This doesn't necessarily mean, as we'll see in this next chart, that just because standard deviation is low, the VIX will spike. It's not that easy. If it was that easy, I wouldn't be doing this presentation and I wouldn't be telling you about it because I would be sitting on my yacht somewhere. It's not that simple. But what it does tell us is that when standard deviation gets low, it should give us kind of a warning sign. It said, okay, there's something that could be developing in the market. The volatility is getting a little bit overconfident because it's not really moving around a lot, and further investigation needs to occur. But we can see here, quite often, the bottom panel here shows the standard deviation. It gets really, really low. So in my paper, the threshold that I used was 0.86. What I had done was just looking at the time of writing the what was in the 10th percentile at that time, what level was that, and that was kind of how I just formalized it for the paper and the example. Using different time frames, you can look at this monthly, weekly, intraday. Looking at from a z-score, there's all different types of ways to look at standard deviation for volatility. So I wasn't trying to present my preferred methodology, just trying to show a concept. And so since I've written this, I've had a lot of people contact me with how different ways they've adapted this to fit their own style. And it's been really neat to see how people have really taken this and run with it and come up with some great ideas. But what this counteracts is this common belief that just because the VIX is low or the VIX is at a certain level, that's the predictor, and that's just not been the case historically. What I think is important is because when the VIX is calm, that people think the market's stable. When VIX isn't really doing a whole lot, there's a little bit of overconfidence, I believe. I believe it's a great sentiment indicator that the market's kind of gotten confident that the market truly believes through the options in the S&P of what volatility should look like. It's not constantly being adjusted. It's really found that level and stuck there, allowing dispersion to come down. And that overconfidence from the options market is what builds up that energy that I think then leads to these large spikes higher. So kind of looking at it all on one table, we can see that when this is from from my paper, the VIX signal is just the dispersion getting below 0.86. Looking at the largest change in volatility over the next 3 weeks, the average, the median, and then also looking at the largest declines in volatility over those 3 weeks, we can see that the VIX 34 to 23, compare that to all the whole sampling, compare that to 25% and 17%. So you can see that the largest outsized changes in volatility occur when standard deviation gets really low. And this also, in my paper, I write that you can also do this with VVIX. I won't dive into that too much in this presentation, but if we look at the 4-week low or just large drops, both of those have lower changes in volatility compared to standard deviation. And then also look at what if the volatility doesn't spike? Well, what's the likely outcome of volatility going lower? 8% compared to all samplings of the largest 3-week drops of 14%. And then again, looking at the 4-week low and then large drops is much larger decline. So if we were just to sample out periods where we're only looking at volatility when standard deviation, when the dispersion is low, then we have a better kind of risk reward profile of VIX going higher versus VIX going lower than we do from some of these more common held beliefs about volatility and just volatility as a whole. So looking just at the last 5 years, so this is just instances of really low standard deviation. I've marked with green dots. We can see that it happens quite a bit. And so what I found was that volatility often will, very rarely do we see a volatility spike that isn't preceded by first the dispersion getting really low, by first the standard deviation getting really, really low. Just because the dispersion's low doesn't mean we'll have a spike, but rarely do we have a spike without the dispersion getting low. And another kind of graphical way to show that is here's the VIX from 2009 through 6/16, so just last week, or I guess that'd be Monday. And looking at each time, still using that 0.86, trying to keep everything standard here. Each time the VIX dropped below 0.86 for the first time in 10 days. So kind of trying to find each unique circumstance. And you can actually see where VIX gets really, really calm here before the 0 line, where it's kind of just settled after dropping down to this level, then it kind of flattens out. And you can see typically we do see, and so after the 0 line, we have the next 3 months, the next 63 trading days. I'm sorry, that's, yeah, a little bit more than 3 months. The next 63 trading days, where VIX typically does start to move higher. Now the degree of change, obviously it's going to differ. We could have what we just had in March, where we have this massive explosion in volatility, or we could have something that's much quicker. Or it happens very, very fast, like in January 2018, where the VIX had a very large spike, but it was just in the matter of a couple of days. And so again, kind of plotting those large spikes in the dispersion, those two charts, I've kind of smushed them together to where we now have the dispersion in the green arrows and we have those large spikes in the red dots. And you can see oftentimes those red dots are preceded by the green arrows, meaning the spikes are preceded by these drops in dispersion. So how can we use this? The way that I use this in my own research and how I manage money for clients is using this, visualizing it as kind of the calm before the storm. If you think kind of the clouds often will darken before it rains, before you have a huge storm, you'll often get some signs where the clouds darken, they start to come in, that maybe the sun gets blotted out. But very rarely do we have a storm without that precursor. It's very rarely do you start having this torrential downpour. Is it possible? Of course it is. But very rarely do you have these downpours without first starting to see some dark clouds. And that's what I liken the VIX to with dispersion, that the very low dispersion, very low standard deviation is those clouds starting to darken. Just because we have dark clouds, does that mean it's going to have a really bad thunderstorm? No. But oftentimes the two are associated together. And so with investment management, within trading, we're just looking at probabilities. And so I think this is an excellent tool to get those probabilities. So now let's look at some examples. So again, here's over the last 5 years, similar chart I showed before of dispersion, of it getting really low. We can see here that in 2008, we saw dispersion get really low. Before this most recent spike, we saw dispersion get really low. Zooming in a little bit more, looking at the 2015 spike, We saw dispersion 3 different times get below that 0.86 level, and then finally the third time preceded the big move higher, where volatility went from 14 to 50 in the matter of 3 days. Those first two, that volatility did go up a little bit, but it really took that third drop in standard deviation before we had this massive move higher. What about the kind of unpredictable events where it's almost like a computer error? Well, look at the flash crash. Again, it was kind of an event no one saw coming, those infamous black swans. But right before it, what did standard deviation do? Got really, really low. So we didn't necessarily know that we're going to have the flash crash back in 2010, but we knew that the market was getting a little overconfident because of how low standard deviation was getting for volatility. So we don't know what the history books will write, but we know the history books are probably going to write something about these events. What about the financial aid crisis? Look at this, right in September, standard deviation got really, really low. There was all other types of data that people were pointing to, that issues with mortgages. You didn't need to be an economist. You didn't need to be a housing expert. But by just understanding the dispersion, you saw it finally dipped back below there in September before kind of all hell broke loose at the end of 2008 with volatility going from 20 to 80. I love this example. They actually put together what would the VIX look like back during 1987. So the VIX didn't get created till 1990. So they tried to kind of come up with a version of what would it look like. And so taking that data, throwing it in Excel, and then plotting standard deviation, we can see there were several times from 86 to 87 where dispersion got really low, and then bam, right before Black Monday, before the crash, once again we saw dispersion get really, really low ahead of Black Monday, ahead of that 87 crash. What about Volmageddon? Anyone that trades volatility, they'll know Volmageddon was when the XIV ETF imploded because volatility had such a large spike. We can see several times during 2007 there was basically no volatility, but we kept seeing these dips in standard deviation that end up being preceded a few little minor pickups in volatility, but nothing until we really had 2018. Again, this was after I had written my paper, to where again standard deviation dropped. Pairing that with a lot of other forms of analysis, we then had the Volmageddon. Here again, 2019 in the current spike, we had back in the fourth quarter of 2018, we had again volatility, dispersion got really low. If you follow my blog, if you follow me on social media, I talked about this a lot back then. Actually, all of these I was talking about on social media, where volatility, dispersion was getting really low. We didn't know why, and honestly, you don't really care why. Again, the history books will give an explanation for why the market does what it does. But from a sentiment perspective, things got too frothy, standard deviation got really low, and then we had the fourth quarter of 18. Here recently, just in February, once again, and since these periods, we did have several times. Again, it's not every time does dispersion get low do we see these spikes, but very rarely do we see a spike that's not preceded by very low standard deviation. And so again, the coronavirus, the lockdown of basically the global economy, sent the markets reeling, sent volatility to the highest level since 08. But what happened first? Standard deviation got really low. Dispersion was telling us that sentiment was way too frothy, way too bullish from a volatility perspective. And so I'd say this is kind of a rinse and repeat process of this happening. Not every time does it precede a spike, but when it does, it sends off kind of a warning sign in my mind, and a further research into using some of my other analysis tools to kind of look at the risk reward within the equity market. And so if you do want to read my paper, it's published on SSRN. It's actually one of the top 10 most read papers, most downloaded papers there. Here's the link right there. If you also just search SSRN for forecasting a volatility tsunami or my name, then you can easily find it and you're able to download it. It's 100% free to read. So definitely check that out if you want to learn more. If you want to contact me, my Twitter, my blog, I manage money for Financial Enhancement Group. That's our website there. I also write a premium institutional research piece at Thrasher Analytics, which is a separate entity there. And I have taken what I use for standard deviation for the VIX, what I wrote in the paper, I've adapted, and I believe I've kind of taken the Model T version from the paper, and I've turned it into what I believe is now my Ferrari. Really adapting this to my own and as a volatility tool, and that's why I write with a bunch of other topics at Thrasher Analytics, and then using this within our asset management at a financial enhancement group. So reach out to me on Twitter, my blog. Love talking with people, especially that have questions about this further after you've read the paper. But definitely happy to answer any questions that you have right now. So with that, I appreciate you sitting and listening to me talk for a little while, but definitely let me know if there's any questions.
All right, Andrew, appreciate it. Great presentation. We had a question come in. They're wondering, does the VIX move before the market, and can the VIX predict the market move?
So I think that looking at it maybe a little too simplistically, we often do, to kind of answer the question directly though, we often do see volatility will move before the market, in the sense that, like I said earlier, that the VIX and the S&P 500 are negatively correlated. When we start seeing them become positively correlated, so when the market's going higher and VIX is going higher, what that's saying is, from an option standpoint, the options market is saying that they're expecting more volatility, because now the VIX is going higher. So the market's expecting over the next 30 days, if you're looking at spot VIX, that it's going higher along with the market. And so when those start to get positively correlated, then yeah, you can maybe, that's forecasting from an option perspective that you could see some downturns or reversal trends in the S&P. That's not always the case, but those correlations can be great tools.
All right, excellent. Thank you for that. Another question popping in. If you want to trade an equity that reflects the changes in the VIX, is there a good trade for that, or is there a good proxy for that?
No, I wish there was. So there's ETFs that trade that try to mimic the VIX. The most popular being VXX. If you were to look at VXX, you'll see it does a terrible job because of the role. It's a whole rabbit hole of why VXX doesn't really give a great track to the VIX. But the best way to get exposure to volatility is going straight through the actual volatility instruments, through options and futures. But I use this I don't trade volatility directly within our client accounts. I do personally, but within our client accounts, I use this as a risk management tool. And so being able to understand what VIX is saying about the equity market, and then adjusting my proverbial dials in equities based off the VIX. So that's just because it doesn't necessarily mean you have to trade volatility or you have to become an options or futures trader. You can still use the VIX within your own research if you're more comfortable in equities or whatever instrument you choose. It can still be a great tool to be keeping an eye on.
All right, thank you so much. Another question came in. They were wondering, does Financial Enhancement Group protect client portfolios using a volatility strategy?
So we don't have a direct volatility strategy. It's a component of the strategies that we use. So we have one portfolio that's called Tactical Edge, that's a little bit shorter term, a little bit more aggressive, and it very much has because I'm the one managing the portfolios. I very much am using these tools along a bunch of others. So we use VIX within our analysis that dictates some of our biases towards equities. But we don't have a direct volatility program or model that trades the VIX, so to speak. That's beyond what we do with our clients. So it's a tool, not an instrument for us.
All right, perfect. Another question came in. When VIX is 2 times its historical norm as it is now, are you then inclined to have a downward bias on stocks in the interim?
If the VIX is, so if we're at above average VIX, so no, not necessarily, because again, I think volatility, a lot of people, when they start looking at volatility, they get a kind of blinded to everything else. They look at it just in a vacuum, and I think there's other data sets. So the fact that VIX is staying elevated is a bit of concern. So if you look at historically past bear markets, if you want to classify this as a bear market, typically it stays within its top 1/3 of its 1-year range. So we're getting a little bit technical here, and you have to kind of imagine this, since I don't have the charts kind of handy to show this. But typically it stays within its top 1/3 range during a bear market. We broke below that about a month ago, earlier in April. We got below the 1/3 range for the VIX. So really we're not, while the VIX is still high for its current range, it's actually come down quite a bit. And so that's kind of one lens I'll look at it. Where is VIX within its 1 year or 5 year or 10-year range, rather than just its actual spot level. If we're at 20, 30, 40, or 8, where is it within its last 1 year range? Because I think it's a great sentiment tool. So if you're saying, looking at it from the last 1 year, where has VIX been? Where's the market taken VIX from an options perspective relative to where it's been recently? Is it really, really low compared to this 1 year range? Then that's telling you that maybe the market's gotten a little frothy. If standard deviation, then start looking at standard deviation, start looking at other things. But I don't look at it just as a pure, the pure level as much as I do the dispersion or the standard deviation of it.
All right, Andrew, looks like we have time for about one more here. Question is, what do you think about trading volatility with ETFs such as the TVIX, for example? I know they may be used for short term, perhaps a few days, ETFs 3 times.
Yeah, for compliance reasons, I can't make recommendations about certain, if I think things are good or bad. I think that there are tools out there for different traders, like the person asking the question, it's intended to be a shorter term focus, because of the downsides to a lot of the way these ETFs are built, because of the roll, where they have to roll down the contracts or roll up the contracts, depending on which one you're looking at. That can provide a pretty big headwind in certain markets. So if you know what you own, I think is really important. Know how those ETFs are built and structured and what their intended purposes are. They can be good tools, but they can also cause a lot of pain if you don't understand them. So definitely do the research before starting to buy things, as applies to all investments. If not, or contact a professional.
All right, Andrew, from all of us at Money Show, we appreciate you being here. Great presentation today.
Thank you.